Good morning, ARMR Insiders. Welcome to another day in paradise. That chart you were just looking at is a chart of the S&P 500. All right? We're going to look at it again in a second. So here goes. These are my thoughts that I've got for the trading session coming up. This is what's on my mind. Okay? Step one, take a look at this chart for me. That's the S&P. I'm going to show you that again in a minute. First thing I want to talk about real quick is booking gains. Okay? Just a note for you guys. I share with you on the ARMR portfolios, those spreadsheets. They show you where we buy each stock, what the date was, what the three principal protection stops are. Low of the day we bought, low of the move we bought, low of the structure we bought. Okay, I will be putting together a piece for you so you can understand those terms better if you're new. Okay, so I'm going to share with you some chart patterns and kind of diagram for you how I come up with low of the move we bought, low of the structure we bought, because I know you guys are asking me that question. So I'm going to work on that. I'll make it an email. I'll send it out to everybody, all the ARMR Insiders. You guys will be able to see. Maybe I'll break down 5 different charts and show you the difference of the low of the move and the low of the structure. Obviously, we know what the low of the day is, okay? But what I don't do is I don't tell you how to trade around the core, okay? It's really up to each and every one of you to determine what percentage of your position's excess and what's core. What that means is when we have a huge month like we've had now and you want to book some profits, don't look to me to tell you to do that, and don't look for me to stop you from doing that. Have at it. Everybody's different. Maybe you're a swing trader and you've gotten the profits you want and you're out. That's fine. Wait for the next idea to show up. If you're a longer term investor, okay, and you're trying to build portfolios and hold them as long as possible, then my idea is trade around the core. So if you've got a 10% position on, if one stock equals 10% of the portfolio, maybe you booked a quarter. So now it's 7.5% of the portfolio. You got 2.5% off to book profits at higher prices, and then you follow the stop discipline, which I will help you with, right? The trailed stops, the raised stops, right? Those are all, profit protection stops. So I'm going to help you with the core part of your portfolio, but I'm going to leave it up to you to determine how much to book from the excess, because I'm doing that right now in accounts that I manage, right? My own personal account and accounts that I manage. I might pare positions back. I don't share with you every day what I'm paring back because it's personal to me and it's personal to each person I work with. Nothing's the same. And if you ask me, well, what do you do in your own personal portfolio? I do trade around the core, but right now with my positions, I'm taking the smallest piece off. Maybe a 10% of my position, just to book something, just to throw the proverbial golf ball in the water, right? Before you line up for a huge tee shot over a large body of water, my dad likes to sometimes, throw an old dirty ball in the water, and then it guarantees he'll split the fairway. You can imagine what our handicap is. Anyway, I digress. Okay, so I'm leaving that up to you. And if you want specific advice, you just kind of reach out to me and ask me, either on the Slack chat or call me up or whatever, and we can go over positions and kind of work through your mind how you should be thinking of this process. Why am I only taking off a tiny piece right now, or nothing at all in a lot of positions? I haven't taken off anything in a lot of positions. Because you don't fight the Fed, guys. You don't fight the Fed. You've heard that terminology before, and yet I can't believe how much I hear on CNBC, how many pundits come on CNBC right now and are coming up with reasons to fight the Fed. Okay? If there's ever a time not to fight the Fed, it's now. There's more Fed intervention than any time in history. And it's open-ended. And yet people who I really respect come on CNBC. Dan Niles, Gunlock, who I really like. I think Gunlock's brilliant. And he's pounding the table. The market's going to make new lows. Now, I don't know. I would just say to you, beware of the pundit calling for new lows in the market. What that really means to me is that somebody's missed this rally. And so they're so frustrated, they have to come up with reasons why the market's going to come back down so they won't be wrong. I hope, if I ever do that kind of thing, please tell me. Because that's pure ego arguing. Okay? We bought the bottom of the market. Not because of my algorithms, not because of my opinion of what I thought might happen, not because I wasn't scared out of my mind, which I was, right? The world was coming to an end. And it didn't feel good to be locked up in your house with your kids. It was an uncomfortable situation. And yet on the 23rd of March, we were buying gold stocks, and then we started filling out the portfolio the next couple of weeks. The reason we were doing it, the reason why I was holding my nose and doing it, is because the Fed was buying everything in sight. Because there's stimulus packages from the government in the trillions. And if I've learned anything in 30 years, it's that you don't fight the Fed. Does this mean the market can't have a sell-off? No, of course it can. And it's pretty vicious. The scary thing right now is it seems like there's no liquidity. When the market starts going down, it just implodes. I missed a short opportunity yesterday in small caps because I just don't believe the market's going down. That's a problem. That's me talking my book. So I'm going to be out there every day now, again, looking for short opportunities to hedge for day traders who want to day trade. And for me, I'm going to do it in my own portfolio. But I've avoided day after day after day. I've seen short opportunities that I thought were opportunities, and I haven't been sharing it in the Slack room, and I haven't been trading it. And every day the market keeps going up, and I've been like, well, I was right not to trade it. Yesterday, there was a great trade, and I didn't trade it. Okay? Because I just don't believe the market's going lower with this kind of stimulus. You all want to say to me, well, here come earnings, and who knows how bad it's going to be. I say to you, people already know that. Who cares? The market doesn't go up and down because of a company's earnings announcement. Could there be a gap down in Microsoft because the earnings no good? Sure. And there's a gap up in Google today because the numbers looked, who knows? The street liked it. Google's up 7%. I mean, you're going to get some gap downs, you're going to get some gap ups. But at the end of the day, that's not what drives the stock market. What drives the market is Fed intervention. What's driving the market is the economy starting to open in the month of May. And I know everyone's out there saying it won't open fast enough. People won't do this. People won't do that. People are afraid. There'll be another, a whole nother slew of virus. I don't know if any of that's true. And I'm not going to start to, think that I happen to have a crystal ball and I know what people were going to do, from a consumption standpoint and whether or not we're going to get COVID again. I don't know. And quite frankly, I don't care. The Fed's liquefying the market's going higher. Let's take a peek at that chart I showed you at the beginning. It's very important. That's a chart of the S&P in 2009. Okay? Now let me tell you something. At the bottom of the market down here, the fear level was absolutely off the chart. Okay? Absolutely off the chart. Right down in here when the market was bottoming, it seemed like the world was coming to the end. I don't know if you guys remember this, but I was in the thick of it, okay? The world was coming to an end. Runs on banks. Pundits telling you to run out there and go to the bank and get cash and put it in, put it under your mattress. You won't be able to get cash. Okay? The Fed started buying the market. The first quantitative easing program. There's a V bottom. There's a rally back. Okay, now look at this. There's a rally back. to the 50 to the 200-day moving average. It pauses there. It pauses. Then it breaks above the 200-day moving average. Keeps on going. Rallies right on through to the next year, 2010, before it ever has a correction of any magnitude. And I would submit to you it's because it was X standard deviations above the 200-day at that point, and it was due for a pullback. Down here, it's below the 200-day. Okay? So look at this opportunity in here in the market coming off of the lows with Fed intervention. And I guarantee, listen to me, guys, look at me. I guarantee pundits were telling you that the market was going to make new lows. I remember. Ben Bernanke's crazy. QE's never going to work. The market never made new lows. The market rallied for a year before there was another investable entry point. Now, history doesn't repeat, it rhymes. But I'm just saying this time around, there's more liquidity by a factor of X. I mean, it's huge. And you've got guys like Gunlack and Niles talking about shorting and the market's going to make new lows. Do you guys remember, and some of you guys in London will remember, a gentleman by the name of Hugh Hendry? He was one of my favorite pundits. I thought this guy was brilliant. I still do. Even though he had 30 billion under management and now he's out of the business. He was so right in 2008 and leading up to 2008. And everything that came out of that man's mouth made sense to me. And he went from a $30 billion fund manager to out of the business. He fought the Fed all the way. He pointed out all the negativity and all the reasons why the market should make new lows and all the reasons why the Fed QE program wouldn't work. And he's out of business. So I don't fight the Fed, and I don't make predictions. This is not a prediction right now. I'm just sharing with you what happened in 2009 when the Fed opened the spigots for the first time. The fear factor was just as high. And I would submit to you, and I'll just wrap this part of this conversation up, I would submit to you that what was going on in 2008 is worse financially for the world and the markets than what's going on right now. This is a man-made shutdown. This is not banks going bankrupt. This is a man-made shutdown that we're going to open up again. And however long it takes to come back on, it's happening, and there's massive amounts of liquidity. And so this is why I missed that short trade yesterday, because I still think the market's going higher in here, which is ridiculous, because I should look for shorts to hedge, and I'll work on it again today and see if I can find entry points going forward. But anyway, those are my thoughts for today. Let me just show you two charts. Why did I sell Ring? Okay, before I hit the stop, I just thought you might want to see this. Whoops, that's not what we're looking for. All right, sometimes, so we sold it before the breakdown yesterday, right? We sold it the day before. Sometimes we all make mistakes, and I'm trying to find the best chart patterns to buy. And what occurred to me up here was, this just isn't a chart pattern that I want to buy. Where's the weakness that I'm really buying, right? We were buying it right in here as it was breaking out. There was no real weakness in this pattern. If I wanted to buy it, I should have owned it down here maybe. I really need to own it down here. Okay? So that's why I really cut that out. It was just, I go through these charts every day. I look at our positions every day. And I say, is this the best possible chart pattern for what I'm trying to do? Am I buying weakness in the midst of strength? And when I realize not really, I'm not, then I have to take the position out and reassess. And in this case, I booked a profit. Okay? So that's why I did that. Intel, I put into portfolios the aggressive portfolio yesterday near the low of the day, and I did not add to it at the close for the balanced and conservative because I really just wasn't sure what the market was going to do today, and I just wanted to take a break. So I didn't do it. It looks like it's going to gap up this morning. So this just may be I'm not going to chase it this morning. For the conservative and balanced accounts, it's going to open around 59 and change. But the reason I showed you this is I wanted to show you it's another chart pattern, just in case you haven't seen this. See, there's the rectangle again. 1, 2, 3, 4, 5 up and out, which happened. It broke out, and then we had a market crash, bringing it down, giving us another shot. So I'm buying the consolidation, the weakness off of this huge chart that's very bullish, right near the moving averages. That's why I like this. So I'm going to try to find a way in, but I'm not going to press it. If I can't find it, we'll just have to own it in the aggressive account and look for other opportunities. I just got to find where the entrance is going to be. It's going to open back up at the VWAP, which is right around here from yesterday. So, be on the lookout today. I might add it to the other two portfolios. All right, guys? I'll see you in the Slack room. Let's have a good day of trading again.